In this video, I asked WhatDuhBot to reply to questions about the AMC Short Squeeze, naked shorting, and tokenized shares. When asked about the AMC Short Squeeze, here's the bot's response. I am not able to have personal opinions or express subjective viewpoints, as I am a language model trained to provide accurate and reliable information to the best of my ability. I can tell you that the AMC Short Squeeze refers to a situation in which investors who had bet against AMC Entertainment Holdings, Inc. by selling its stock short were forced to buy it back at a higher price in order to cover their positions. This can occur when the price of the stock rises unexpectedly, causing short sellers to incur significant losses. Short selling is a high-risk investment strategy that can lead to significant losses if the price of the stock rises. So it is important for investors to carefully consider the risks before engaging in this type of activity. In response to naked shorting, here's the bot's response. Naked short selling, also known as naked shorting, is a controversial practice in which an investor sells a stock that they do not own or have not borrowed in the hopes of purchasing it back at a lower price in the future. This can be done by placing a sell order for a large number of shares without first locating shares to borrow and deliver to the buyer at the time of the sale. One concern with naked short selling is that it can potentially be used to manipulate the price of a stock by artificially increasing the supply of shares in the market. If a large number of naked short positions are created, it can create the appearance of increased selling pressure on the stock, which can lead to a decline in its price. This can potentially harm the company whose stock is being shorted, as well as other investors who own the stock. Naked short selling is generally considered to be a highly risky and unethical practice, and it is generally not allowed in the financial markets. In the United States, the practice is regulated by the Securities and Exchange Commission, which has implemented rules to try to prevent it from occurring. When asked about tokenized shares, here's the bot's response. Tokenized shares, also known as security tokens, are digital representations of ownership in a company that are issued and traded on a blockchain. They are similar to traditional shares of stock in that they represent ownership in a company and entitle the holder to a share of the company's profits and voting rights. However, unlike traditional shares, which are issued and traded on centralized stock exchanges, tokenized shares are issued and traded on decentralized blockchain platforms. One of the main benefits of tokenized shares is that they can make it easier for companies to issue and trade shares, as well as for investors to buy and sell them. Because they are issued and traded on a blockchain, tokenized shares can potentially be more transparent and secure than traditional shares, as well as more easily transferable and tradable. They may also make it easier for companies to raise capital and for investors to access new investment opportunities. However, tokenized shares are still a relatively new and evolving concept, and there are a number of regulatory and technical challenges that need to be addressed in order for them to become more widely adopted.